All right, welcome to today's Explainer, first-year accounting students. Today, we're actually going to solve what I like to call the ultimate business mystery, finding out exactly where the money went. You know, you've spent weeks mastering the income statement and the balance sheet, but today we're tackling the third major pillar of financial reporting. We are going to decode the statement of cash flows and learn how to track the true lifeblood of literally any business. Okay, let's dive right into this missing cash mystery using Shopmart's exact 2025 numbers. Consider this question. If Shopmart's celebrating a very healthy $40,000 net income on their income statement, how on earth did their actual bank account balance drop by $20,000 over that exact same period? I mean, it feels like a total contradiction, right? But this perfectly proves that a highly profitable company can still be bleeding money. And as an accounting student, you need to understand exactly why that happens. So, here is our roadmap for today. Number 1, the missing cash mystery. 2, categorizing cash flow activities. 3, direct versus indirect methods. 4, reconciling the indirect method. 5, non-cash investing and financing. And finally, number 6, evaluating free cash flow. Section 1, the missing cash mystery. We really need to start by understanding why accrual accounting alone just isn't enough to run a business. Think of it this way. Accrual accounting, which drives your income statement, well, that's your car's speedometer. It tells you exactly how fast you're generating value right now by matching up revenues and expenses. But cash flow is your gas gauge. It tells you if you actually have the fuel to keep the engine running. Management constantly prioritizes the cash flow statement, specifically operating cash flow, because, let's face it, driving a fast car means absolutely nothing if you stall out on the highway from a lack of gas. You absolutely need both instruments to drive safely. Section 2. Categorizing cash flow activities. So to find our missing gas, we literally have to sort every single dollar moving through the business into 3 very specific buckets. What's really interesting is how perfectly these cash flow categories map directly back to the balance sheet accounts you already know. Operating cash flows are tied directly to changes in current assets and current liabilities. Then investing cash flows connect to long-term assets, things like buying a building. And finally, financing cash flows are mapped right to long-term liabilities and equity. This setup is basically your cheat sheet. If you know what part of the balance sheet is changing, you know exactly which cash flow bucket it belongs in. You're definitely going to want to memorize this quick reference checklist because properly classifying these daily activities is the entire foundation of accurate cash reporting. Operating activities are the day-to-day things, right? Collecting from customers or paying for inventory. Investing activities are the big moves, like buying or selling property, plant, and equipment. And financing activities are how you fund the whole operation, issuing stock, taking out a loan, or maybe paying dividends back to your shareholders. Section 3. Direct versus indirect methods. When we're calculating those absolutely critical operating cash flows, companies actually have to choose between 2 distinct reporting methods. Now, the crucial point here is that while both methods get you to the exact same final number, their approaches are completely different. The direct method is very straightforward, but honestly pretty time-consuming. It literally lists actual cash receipts and payments, restating the income statement line by line into pure cash. The indirect method, on the other hand, which the vast majority of companies use, by the way, acts much more like a financial detective. It starts with your accrual net income and uses mathematical adjustments to basically re-engineer that number back into pure cash. Section 4. Reconciling the indirect method. All right, let's roll up our sleeves and tackle the heavy lifting of the indirect method. Because as an accounting student, this is where you're going to spend most of your time. These 5 sequential steps are the exact procedure you must follow to prepare a complete, accurate statement of cash flows. You start with operations, naturally, because that's the core of the business. Then you map out investing, followed by financing. Once you tally those 3 up, boom, you get your net change in cash. And finally, you disclose any major non-cash activities down at the bottom. So here's Shopmart's reconciliation in action. Remember that $40,000 net income we talked about? We start there, but then we have to adjust it. See how the $20,000 depreciation expense is added back to net income? That's because depreciation is basically a phantom expense. It lowers your net income on paper, sure, but you didn't actually write a check for it this year, so we just add that cash back. Conversely, look at the $10,000 gain on disposal of plant assets. We actually deduct that from operating activities because that cash belongs down in the investing section. We're really just filtering out the noise to find the pure, real operating cash. Now, for changes in working capital, which again are your current assets and current liabilities, just remember this one golden rule. Current assets move in the opposite direction of cash flow, while current liabilities move in the exact same direction. Think about it. If your merchandise inventory, a current asset, goes up, it means you spent cash to buy it, so your cash goes down. Opposite directions. But if your accounts payable, a current liability, goes up, it means you held onto your cash instead of paying your bills immediately, so your cash balance is effectively higher. Same direction. It's that simple. Section 5. Non-cash investing and financing. Okay, so next up, we have to account for these massive transactions that completely change the company's structure without a single dollar actually changing hands. Look at these real-world examples. Imagine acquiring a $300,000 building, but paying for it completely by just issuing shares of your company's common stock, or maybe trading a note payable for $70,000 worth of land. These are monumental business decisions for sure, but they don't touch the cash account at all. And because they bypass cash entirely, they aren't mixed into the main cash flow statement. Instead, they're reported in a completely separate schedule at the bottom of the statement or in the notes, just to ensure full transparency for the investors. But on the flip side, we do have financing activities that actively drain cash. For instance, Shopmart used exactly $20,000 in real cold hard cash to purchase treasury stock, essentially buying back their own shares. This is a clear cash outflow in the financing section, and it brilliantly illustrates how financing decisions can directly drain your overall reserves, pulling from the very cash you worked so hard to generate from your daily operations. Section 6. Evaluating free cash flow. Now let's see how investors actually use all this verified cash data to make real-world business decisions. Free cash flow is honestly the ultimate health metric. Why? Because it reveals exactly what a business has left over to aggressively expand or to reward its shareholders. It's your net cash provided by operations, minus the capital expenditures needed to maintain your assets, minus the dividends you've promised to pay out. Think of it as the true disposable income of the corporate world. Let's look at Shopmart's reality here. They generated an impressive $200,000 from their day-to-day operations. Sounds pretty great, right? But hold on. After spending $160,000 to modernize their retail facilities, which they absolutely have to do to stay competitive, and paying $15,000 in cash dividends to keep their investors happy, their free cash flow is actually just $25,000. That massive $200,000 shrinks very quickly when you account for the cash required just to sustain the business. And this brings us right back to our opening mystery. A company can show amazing profits on paper while completely draining its actual bank account through massive investments or debt repayments. So I leave you with this final thought. If your accrual speedometer says you're flying at record profits, but your free cash flow gas gauge is flashing empty, how long until the business stalls out entirely? Think about how these two critical financial tools, the income statement and the cash flow statement, really have to work together when you're evaluating business health. Keep studying those financial statements, and I'll see you in the next explainer.